Apollo Hospitals is the top Nifty gainer after a good set of numbers in the second quarter. Margins and profit beat market estimates. MD Sunita Reddy tells CNBC-TV18 that the occupancy will be at 70% and the average revenue per occupied bed will cross 60,000 rupees in the second half of this year.
In stark contrast, Hindalco, the biggest Nifty loser after its subsidiary. Novelis reports a weak second quarter. They also withdraw its short-term guidance on an EBITDA per ton of $525 per ton. That's the factor that's sinking the stock.
Gujarat Gas is up in trade after reporting good second quarter results. The company sees strong margin expansion year on year. The stock up 3%.
And Blue Star reports a stable set of earnings in the second quarter, but the stock slips more than 5%. In fact, now it's down close to 8% after regulatory setbacks in commercial refrigerator business and production delays of new range affected revenue growth of the UCP segment.
Rain Industries falls in trades after reporting its second quarter results. The company's consolidated net loss rose to about 179 crores, while sales declined by over 5% year on year.
Hello and welcome to Chartbusters. I'm Nigel. With me is Maglam, and we have a couple of managements on the show. So let's get straight to the action. IT consultancy company eClerx reported a strong showing in the second quarter. The company reported near 6% growth in dollar revenue terms sequentially, and the constant currency revenue was also higher by close to around 5.7% on a quarter-to-quarter basis. To help us out with what went on in the past quarter, Mr. Srinivasan, the CFO of eClerx, joins us on the show. Hi, sir. Good morning, and thanks a lot for joining in. Well, we haven't seen this sort of a solid growth. It was around 5.7% quarter to quarter in the last few years. Any one-offs? Is this number sustainable? And also, you've indicated that growth was aided by financial services growth. Could you tell us how much was that?
Thanks, Nigel, for having me on the show. So yes, this has been quite an exceptional quarter, and there were several short-term projects in both our financial services business and our customer operations business, which led to this growth. We don't specifically call out the contribution of each business, so I'll be unable to provide the detail or color on what financial services contribution was. But I think it was obviously stronger than the firm growth.
Well, it's good to see that there was strong growth. And as you're mentioning, there were some short-term projects that got executed. But is this sort of a momentum sustainable? And if you can't break up the growth for us, you could also give us an insight about how much financial services is, as a percentage of your total sales mix.
Financial services is about 40% of our total book. And in terms of growth momentum, whereas while I'm unable to comment on short-term changes in demand and short-term scenario, but the long-term outlook seems positive. So we are having a lot of conversations in financial services with clients. We're participating in a lot more. We're seeing a lot more deal activity. And even on the customer operations side, we're seeing significant activity. On the digital side of our business, I think there is some concern, especially with fashion and luxury.
Got it.
But other areas, the outlook seems to be improving.
And there has been a fair amount of growth in both fashion and luxury over the last couple of years, so maybe the base is extremely high as well, while as there is prospects for growth coming in the financial services. Just a quick clarification before we move forward. You said that it obviously grew faster than the industry average. Could you give us a sense of perspective? How much faster? Was it 1.5 times? Was it 2 times? Just a rough, breakup, if you could.
So again, I will not be able to comment on that. I meant that it grew faster than firm average, not industry average. I don't have the industry numbers with me.
No, by firm average itself. I mean, we were just trying to take our chances out there. But also in the conference call, you did say that there were a couple of roll-offs which will show full impact in the third quarter. I presume roll-offs are orders which have slipped into the next quarter. So to that extent, does the second half look better than what has happened in the first half for you?
So roll-offs are projects for us. Roll-offs are projects that have ended. So there was
they have ended.
Short-term work that we were doing, and that has come to a planned end. And therefore, I think the point that we were trying to make is that we will have to sort of replace that revenue and find more work to be able to sustain the same amount of momentum, and which we think is going to be a little tougher.
So what is sustainable in that case, according to you? Because if you look at the trend, this quarter obviously was a lot higher because of these short-term contracts. A normalized 3-4% sort of number would be a lot more realistic?
Again, we don't give guidance either for the full year or for the next quarter. So I'll be unable to provide sort of any commentary on that or any color on that.
Okay. Srinivasan, in the previous year, I think your margins were in that vicinity of 28 to 30%. Then for this year, you have guided 24 to 28%, and you have achieved close to 27% in the past quarter. Do you think for the second half of the year as well, you'll be closer to the higher end of the range, which means for the year, you'll be closer to around the 28%?
So there are some one-offs in this quarter. If you look at Q1 plus Q2, which is, I think we are somewhere around the 25.1% mark, which is a little lower than the midpoint. So I think if things go well, that is probably where we would.
All right, around 25%.
So around 25.5% should be a fair estimate.
Possible.
All right. On the growth itself, you said that the second quarter had a fair amount of short-term contracts, etc. We had about 5.7% growth there on account of that. Could you quantify how much of this extra growth came in from short-term contracts?
Again, that's something that we don't call out specifically. So
we're trying our best to, just understand what is a normalized run rate out here and what happens. But
I'm trying my best not to reveal much.
We try to paste in and try to bowl the googlies, but it seems for now, at least, you're
he's either doing a well left or just defending it.
But we're not going to let you hit it out of the park. So let's get straight to another part of the business. So the street fears that AI could be a bit of a risk to your business. I wanted your comment on that.
So there will be some automation that happens in all the processes that we do, but we see it as more of an opportunity. So we offer several productized services as part of our operations portfolio, and many of our tools internally also use Gen AI and AI ML kind of technologies.
Got it.
And some of these have found favor with clients. So we see good traction there, and hopefully that part of the business for us will grow.
The good part about the second quarter numbers was that you said growth in North America was fairly strong while Europe remained challenging. But again, the question is, post-US election outcome, do you see more ordering coming in from the US, or maybe post-Trump regime, there could be some sort of risks? Just wanted to understand how this space pans out, specifically for your business.
We would, I think, wait and watch, because we are not sure whether what the commentary during campaign is, whether that will be implemented as part of policy.
But you have a precedent, right? You have a precedent. He was president earlier as well. So were there any challenges?
I don't think there were too many. On the supply side, the constraint on H1B could come up, but we don't use a lot of H1B, so that's not that much of an impact for us. Whereas on the demand side, if taxes go down, then obviously all companies will benefit. And we should see some pickup there.
Got it. Thanks a lot for that. Wishing you all the best. In this sort of a market, your stock is still holding up with a gain of around 2.3%. Tells you the street like those numbers. So as you're clarifying, there were a couple of one-offs in the past quarter. Though fairly confident about sustaining margins at around 25 to around 25.5%. For the time being, we'll slip into a short break. On the other side, we'll be joined by the management of NIVA Bupa Health Insurance to discuss their IPO launch and post-listing plans.
Welcome back. You're watching us here on Chartbusters. Let's shift focus to the primary market. NIVA Bupa Health Insurance IPO opens for subscription today. Price band at around 70 to 74 odd rupees. We have Krishnan Ramachandran, who's the MD and CEO of the company, along with Vishwanath Mahindra, who's the CFO of the company. Thanks a lot, gentlemen, for joining in, and good luck for your stint on D Street itself. And we hope it's a very successful one for you and your shareholders. Krishnan, let's start about talking about growth, right? Over the last few years, you've been growing at least 2x the industry. I just wanted to know, one, at what level are you expecting the industry to go forward, and will you continue your outperformance of growth when it comes to the industry by a factor of 2?
Firstly, thank you very much for for the opportunity to be on your show, as well as the good wishes. I really appreciate that. Yes, we have been growing at a CAGR of 41% over the last 3 years. And it's been on the back of several investments we've made as a company, whether it's on brand, on distribution expansion, on talent, on technology, and certainly some very, very innovative products. As far as the future is concerned, we do expect the health insurance industry to grow at a very healthy clip. Analyst estimates are 17-18% CAGR into the future. And we do believe, as Niva Bupa, we're very well positioned to grow faster than industry. So yes, very, very excited about the opportunity in health insurance. Very excited about the role that health insurance can play in the economic growth of the country, and the contribution that Niva Bupa can make on this front.
All right. Hi, good morning, gentlemen, and good to see you all in. This is Nigel on this side, and welcome to the stock markets. Well, if you could give us your sense, your market share has increased since you have been growing at a faster clip than the industry. Could you tell us what is the updated market share and where is it headed?
Yes, we have. Our market share has also improved. To put it in context, in financial year 20, we had a market share of 4.1% on retail health. That number in FY24 has grown to 9.1%, so more than a doubling of market share. As we speak, as of end of August, this is publicly available information, our market share is close to 9.9% on retail health. And retail health has been our focus area. We believe it's the most attractive segment within health insurance. It is intensive, execution intensive, and there's a premium to how well we do on talent. And I do believe that as Niva Bupa, we do an outstanding job on talent. We are ranked, as a great place to work in the top 25 in the great places to work, a Trust Index score.
Right. So then two-part question then, just to follow up on what my colleague was asking. At what rate do you expect to grow faster than the industry? That's point number one. Secondly, in the retail segment itself, your market share is 9.9%. How much faster can the retail business grow in your overall scheme of things?
So look, Nigel, in terms of our ambitions, we do this as part of our annual operating plan process every year. And to give a specific answer at this point, honestly, I'm not in a position. All I can say is that, we are ambitious. We do want to capitalize on the health insurance opportunity in India. And we do intend to grow faster than market. What that number is, I cannot comment. But what I can say is that the ingredients of our growth in terms of doing the right thing for customers, example, the 92% plus claim settlement ratio we have, the fact that we have a 90% plus, renewal rate, I think those ingredients will continue.
All right, let's bring the money man in then. Vishwanath Mahindra is also with us. Vishwanath, thank you for joining us for this conversation. My question is more related to the operational side of things, because one, your expense ratio is at 40%, higher than the regulatory limit of 35%. So what's your glide path to bring it lower? And an other aspect of that would obviously be your combined ratio. So once your expense ratio reduces, your combined ratio obviously will start seeing improvement. So what's your target out here? Currently, it's at around 107, 108 in the first half of this year. What's a sustainable number that you're targeting out here?
Sure. So thank you very much. So in terms of expense ratio, you're right. It is 39% last financial year, and we are committed to bring it down to regulatory limit of 35% and some allowances in next financial year, which is FY26. And this is coming from a few things like Mr. Krishnan talked about, the growth of more than 41%. What that meant is that our manpower increased fourfold in last 4 years. The number of branches have increased from 50 to more than 200. And all this investment had some bearing on expenses, but this is giving us already good results. And you can see that in CAGR of last 3 years, as the book grows, and which is happening every month, what happens is we get economies of scale and we get operating leverage, and that is something which is helping us in bringing down this expense ratio. And there has been improvement in last 3 years, 150 to 100 basis point every year. So that gives us confidence that we'll be able to bring it down to regulatory limit of 35 plus allowances in next financial year. In terms of combined ratio I have mentioned about 106% in first quarter, but you need to see in the context this seasonality in business, seasonality in earning, and that's why the combined ratio of first quarter is higher. Just to draw comparative, the combined ratio of last financial year first quarter was 108%, and we ended at less than 99% for the whole year. So it has to do more with seasonality, and otherwise for the whole year you need to really compare for last 2 years and quarter one. That will give you some idea. Yeah.
All right, we'll get some more forward-looking numbers from you the next time both of you all join us. Thanks a lot, gentlemen. This was a bit of a tease into what your business does, but what it can do is something that we'll quiz you on when you come back on the listing day itself. Thanks a lot for joining in. We'll take a short break, come back, get you more on the markets and a lot of other stock-specific action. Stay tuned. Well, some of the gains from the last couple of days have been given up on the frontline indices, as you can see, but we're down but not out. The mid-cap index is still mildly outperforming, and from the lows, the Nifty has actually seen a recovery of almost 70, 80 odd points. So we'll keep an eye out on the important levels of 24,100 to 24,150, which earlier were a resistance. Now, after having crossed that, may perhaps prove to be a bit of a support.
The index on top of your head, Manglam, that one is going to move into the green, which is the mid-cap index, and that's why portfolios will be feeling quite good. Well, on that note, though, we'll wrap up on this edition of Chartbusters, but the team of Trading Hour is waiting for you on the other side.